So jumping into our first slide here, a nice planning analytics for global consolidation slide, what a financial consolidation might look like generically, so not specific to PA. But in the upper left-hand corner, we have the finance systems and ERP systems. And so your different general ledgers and such, could be one, could be multiple. They all flow into the model being comprised of the big wide oval here, and that covers topic number one of merging different data sources. So it doesn't just have to be your sole ERP, but if you end up doing a merger, you bring in a different data source and bring the two together as well. Big strength of the tool. Once we're into PA, we can do local adjustments, currency translations, which is another topic we'll get into and demonstrate. Can do intercompany eliminations, investment eliminations, group adjustments, and all the while doing allocations from a top level or a detailed level as well, and the ability to have workflow and control over the consolidation process. So very customizable, and TM1 of course allows flexibility to really custom tailor to your organization and fit your consolidation needs. And so hopefully there's an opportunity that you can cover the vast majority of your financial close, as well as your budgeting and forecasting and reporting in TM1. Moving on to the next slide, we'll jump into topic number one, merging multiple data sources. I'm sure everyone is already familiar with merging in your source data via ODBC or via a flat file. So any database that's come online in the last 20 to 25 years should be compliant and compatible to direct connect to your planning analytics system. Now, what happens when you're a global customer and you go through a large merger, and say we're an Oracle shop and we pick up a company running SAP? Well, a big value add of PA that I've seen over the years is the ability to get a consolidated set of books together very quickly. Whereas a ERP merger of Oracle and SAP could be a 18-month to 2-year project in the millions of dollars, TM1 would be able to accomplish that in weeks, and we have done that before. So very big value add to be able to merge those data sets, as well as possible offline data sets. Maybe you have some foreign entities that don't have mature kind of bookkeeping systems, and they are running Excel and kind of keeping a general ledger, but you still need to incorporate that data into your global set. So perfectly capable of reading in all those different data sources to make sure you have a complete single source of the truth of all that financial data and statistical data as well. Typically, large organization, you're not going to have all of that information in one ERP. So none of your ERP systems or GL systems can serve as the single source of the truth, and therefore TM1 comes in and handles that need for you. To do that, you're going to need mapping and merging of your chart of accounts. Maybe different entities within the organization run a different COA. TM1 is beneficial in that regard, that you can maintain mapping tables and be able to compile those disparate sets of or accounting systems and compile them into a common reporting flowchart, or chart of accounts, I'm sorry. We'll get into that in the demonstration as well. Some possible candidates for inclusion into PA. Of course, sales revenue data is pretty common, whether that be at just the financial level, or we get down to the product level and statistics and price information. We can bring all of that into PA to merge in that data source. And if you have several different sources of that sales data, again, TM1 can be the place where it's all cobbled together. HR data, very common as well. Being able to usually that's the starting point, OpEx and payroll data, and so bringing that in from like an ADP or an UltraPro and having that level of detail, because that can oftentimes be your largest expense as a company, is your human costs. So bringing in those salaries, benefits, tax information, commissions, even having the ability to transfer employees in your budgets and forecasts, and seeing what that looks like, or partially allocate certain members of the organization to separate entities and departments. TM1 can cover you there as well. And then we cover the offline data sources. Perhaps you have a foreign entity, sometimes South America or Africa-based entities that just have an Excel sheet or a flat file of their general ledger transactions. Still needs to be accounted for. So we go ahead and flow that into the TM1 model, able to report that global consolidation. And lastly, the posting back to your ERP system. So merging, not only merging the data source data sets into TM1, but feeding TM1 completed budgets and forecasts back to your ERP system. Oftentimes for archiving purposes, customers will want to see those completed budgets back stored into their Oracle system. So we're able to do that as well. I'm gonna hop over to our demo system at this point. And again, wanted to invite everybody to ask questions. Happy to cover any questions as we go along, or reach out to us afterward if you feel like it, and we'll handle any questions you may have. This is our SmartCo demo system, and I've put on kind of a skin for a control panel here that kind of drives the whole reporting and planning process. So from our main page here, the first thing I'm going to highlight is icons for our different TI processes to upload different data sets and merge them into our common set of books. So for this example, we're showing Oracle, Workday, and an offline Excel file. And we can set that up so that we're just running TI processes and sync that. I don't think we need to get into the minutia of TI processes, but just kind of from a conceptual standpoint, wanted to, make sure everybody's brainstorming and seeing, are we capturing all that data, or is there parts of the organization that it's just always been in Excel and we're only leveraging TM1 for planning purposes, or just parts of the organization? Just from our experience, a lot of customers are taking advantage of TM1 to cover the entire enterprise organization's data set. So can load in all those different sources. Go ahead and click into the GL load view and review all the data we've just loaded, kind of do a search for any outliers that might pop up, make sure that there's nothing we need to investigate, any poor source data that we need to investigate further. Also wanted to jump over to my attributes section, and so I'm going to jump into hierarchies. And here I have member attributes of the accounts dimension. And as I highlighted in the slide, we mentioned that we can have chart of accounts mapping tables. That can be pretty straightforward. Just if we're going off of our main chart of accounts, maybe I add an attribute for SAP account. So if we're an Oracle shop and we just acquired an SAP company, go ahead and create an attribute for that. And whereas this Oracle account might be 6,000, I can go ahead and populate the attribute for SAP as maybe a 6-digit. I have been noticing that this is slightly buggy, that it keeps refreshing my screen, but if I refresh, it should come back to me. There we go. So 1000. So just populating those different values. Click out and click back in. And then, of course, leveraging your TI processes to go ahead and read off of that new SAP attribute. You'd be able to use that as your mapping driver. Very refresh happy today, but hopefully that illustrates the point. And of course, that can be live, maintained throughout. Hopefully it doesn't change, once that chart is set up. You have a proper mapping, one-to-one or many-to-one relationship, and that's of course stored and visible within TM1, so you're able to maintain that mapping. Usually the most difficult part, of course, of the merger is having the accounting team make those decisions as to how are we going to zip these two together and decide apples to oranges, what accounts have what in common, so that we're able to properly map them and get a true reporting of both systems. Jump out of that. And back to the main page, and I'll jump back to slides. So please feel free to ask any questions on merging multiple data sets. But obviously tons of value add there within the planning analytics tool, because there's likely going to be some data sets that you're not already incorporating in the system. So common when customers get together and do a blue sky kind of assessment of what they want to add as future projects and future phases, they identify further data sets that they might not be incorporating, or might be using a third-party tool, or just doing in Excel. And so there's often wins long-term that you can get by gradually cobbling everything together in planning analytics. Okay, so the next topic, currency translation. Currency translation can cover both reporting, budgeting, and forecasting. And we've seen ERP systems that do handle it for actuals. Others don't, but yeah, it's kind of a mixed bag of what we've seen. And so companies will either opt to bring over that translated data one for one. So they could read in both the local currency as well as the reporting currency or US dollar values, so that you wouldn't need to translate the currency within TM1. But other customers only have the local currency available, or vice versa, only have the USD available and would want to translate back to that local for the purposes of seeing actuals alongside budgets and forecasts. So everything's on the table, of course, very flexible, very customizable. One thing, important thing when we're looking at a currency translation module is to properly assess the requirements. Some customers come to us at first and say, we want to be able to see every different data point in any different currency. But the business case just doesn't make sense. There isn't an instance where the Russian entity wants to see their data in Australian dollars. So there's very little point in trying to get that much flexibility in there, because it does end up doing a performance hit and can be a nightmare when it comes to auditability. Much better off just going with the local currency translated to reporting currency approach. So that entails having one member or one element for local, and then one element for reporting currency, or usually USD. For the rest of the demo, I'll refer to it as USD. And then we're just translating that local currency by that local rate to get into USD. So much preferred going that route, as opposed to the ultimate flexibility case. We are able to handle unlimited currencies. Happy to say unlimited in this instance, because there's only a couple hundred currencies out there. Not something that can get too crazy into the thousands. So, I think that the most currencies I've worked with, 15 to 20, is a pretty huge organization and working in a lot of different countries. So easily able to handle that, and we're allowed to have different rate types as well. And we'll get into that in the demo as to what I mean there. Currency translation adjustment has to do with the translation rates of income statement accounts are different than the end of the month rates of balance sheet accounts. And so when we roll the net income from the income statement over into the equity section of the balance sheet, that can create an outage known as the currency translation adjustment. Planning analytics, of course, you can build in calculations to compensate for that and to accurately represent your currency translation adjustment when it comes to your USD reporting. And lastly, we do have the opportunity to automatically update the rates, whether that be from your source systems. Maybe your ERP system has rate tables for currency in there, or maybe it's a flat file in Excel that's maintained in some part of the organization, or maybe we can tie into a third-party website that publishes the rates. It is helpful if you do have, a lot of currencies in the organization, as it can be tedious to manually maintain those currency rates each month. And so we'll jump over to the demo again. I'm going to look at the financial summary, so our P&L at the end of the line from all the planning. And we have a month, current month, YTD, and yearly report for our P&L. And we see we're in Massachusetts, and March 2020 local currency. We're in local, but I would want to first switch over to an international organization. Otherwise, we're not going to see anything, because anything domestic US gets translated one for one. And if I go over to Ontario, I see I have 837,000 in gross revenue for local currency in the Canadian dollar. I'm going to open up the rate table, which is signified by this dollar icon. That pops open the rate table, and we are able to put in different rates for the months and years. And as we mentioned, all the different currency types. We have USD, Canadian, and GBP for our sample set. USD, of course, being one all the way across the board, because that's going to be our reporting currency. So no need to translate there, but we do have to make sure it has a one in there, or it the multiplication does need to have that one value. And then for Canadian and GBP, of course, changes month to month. I've just copied in the same values for everything. So typically your average and your month end would be different, but for sample sake, they've just been all the same rates posted. And then we have spot rate. So first of all, the average rate is what we use for the income statement. And that's just the average daily rates all cobbled together for a monthly average. The month end, of course, the last day of the month, we'll publish the rate, and that's what the balance sheet gets translated by. And then for spot rates, we can have any number of spot rates you might need. And those come into play when you might have an equity transaction, a very large equity transaction in the distant past that has to be maintained at a certain rate. So if you don't want particular equity balances to be translated on a monthly basis, thus subjecting your financials to a very fluctuating US dollar value based on currency changes, we can tie in that spot rate when that transaction occurred and preserve that currency rate. I believe that covers everything here. Of course, flexibility to model in both actual and budget. So actuals you just bring over from the online rate tables or your organization's rate tables. Budget, we can project out in the future and say, are we getting any drastic changes in rates between the different countries, which obviously has been happening a lot as of late, but that would give you the ability to project if, say, the dollar was getting stronger or weaker. So just noting in Canadian, we have about a 0.75 across the board. And so we'll see how that translates when we get back and toggle from local to base. So going from local currency to reporting currency. And our 837,000 has dropped down to 627,000 USD. And of course, able to do that for actuals and budget and display the variances accordingly. So very handy once you have this all set up that you're handling all that currency translation for all the different entities by all the different currencies. And if you can automate the updating of the rate table, then you're 100% automated. So currency, you don't even need to worry about it. There's also, of course, attributes by country to identify which countries use which currency. There are some entities, especially European, where they might use the euro, or they might use GBP, or they might just report straight in USD. So just because a country is not in the reporting currency doesn't mean it can't use the reporting currency as its local. That can all be identified by attributes. All right. Jumping back onto our slides, and we'll go to our next topic of allocations. Allocations, this is probably one of the more exciting ones, is the ability to redistribute usually your expenses across the organization. You might typically have a headquarters that generates a lot of expense but doesn't put any profit on the board, and you want to allocate their expenses across all the profit generators. So very common to set up allocations to accomplish this in TM1. And you have the ability to do that manually if you just want to go ahead and post credits manually to that headquarters organization and then repost that value as a debit over on the profit generator. But more commonly, we prefer a driver-based approach. So we can do set up the allocations to run off of different drivers, and we can automate that with rules or TI processes. Different benefits with using either rules or TI. Of course, rules is the obvious benefit that it's real time. We can easily model different scenarios. Say, okay, what happens if we allocate 100% of the cost expense? What if we allocate by headcount versus allocating by gross revenue? So it's really good ability to see that real time. But of course, with rules, they have a performance hit, so you have to be cognizant of that. If there is going to be too much of a performance hit, maybe we look at the TI approach, and the TI process driven allocations gives you also the ability to step through to where you might not want to allocate A to B, take the result, allocate the result of B into C all at once with a rule-based approach. In a TI process driven approach, you can step it out into multiple layers and then just have a chore to run the whole process at once, or go into the individual steps and run them and then audit them. So it's of course always required that we have good validation and the ability to true up our allocations as we go through. So we'll identify that as well in our demonstration. All right, back out to the main page, and I have an allocations tab. So I'm going to hop over to that. And what I'm looking at here on top is our input screen, where we input whatever allocations that we are putting in. Toggle this to budget. And I see we have 3 in there already. And it asks us for the source entity, a description, what account is to be allocated, and then it pulls up that value from the income statement, which I'm displaying down below. I have the opportunity to allocate by percent. So if I don't want to do the whole value, I can decide a certain percentage of that cost I'm going to allocate. And then I also decide the driver. So I have various different drivers I can choose from, whether they be statistical or financial, but of course, total flexibility in TM1 to model this according to our organizational needs. So let's go ahead and step through the first allocation example here. I see I'm in 2020. In the budget, my source entity is Massachusetts. I can go ahead and look up from the P&L down below and see that I have Massachusetts, and I have travel, and I have my 152,000. So that's what's getting populated. I've elected to allocate 50% of that across the organization, which results in an allocated value of 76,000. And I'm going to allocate by FTE. So conveniently, I've also displayed the statistical accounts on my P&L, and I have my FTEs for the 10 organizations, input level organizations of SmartCo, and I can see what ratios are kind of going to generate here. So Massachusetts is pretty small, Florida being the largest, so it looks like Florida is going to pull 20% of the allocated costs, 10 out of 50. But of course, FTE does fluctuate throughout the year, so it's not going to be a perfect 20%. But of course, FTE is a great driver to decide how you should allocate your expenses. So let's walk that through to the summary. We have 152,000, of course, getting split 76,000 One other note, I'm not demonstrating, but we also have the ability to flag regions that won't receive any of the allocation. So if we decide, oh, Illinois and California aren't going to bear the brunt of that travel cost, we can exclude them from the allocation. But for this example, we're going to do everybody. I'm going to hop over to allocation summary. Again, 76,000. And I see for budgets, I need to update back to allocation 1. And I see my 76,000 is the allocated amount. And I have a credit entry in the far right column, because we're going to remove that from Massachusetts. And then we're going to put back 6,000 per the 3 employees of Massachusetts. And if I look over at Florida, I believe it was, that's close to 20%. So that received the lion's share. And of course, divvied up all across the rest of the organization based on their headcount. In the bottom of this pane, I have the P&L again, and that is showing me the allocation accounts in the P&L that are receiving those allocated values, as well as the credit entries. So it's pretty transparent on the allocations out. We're removing 76 from Massachusetts. What's a little bit muddier is allocations in, because that is a summation of all of the allocations, not just allocation 1. And if I run a trace cell, I can say pop open March and see different values for March per all the different allocations. So allocation 1 value in March was 596, allocation 2, 750, and so forth. And you can build out the model differently if you needed more visibility to the individual allocations at the summary level. All right, let's go ahead and do another one. Hop back into allocations, and this time we'll look at allocation 3 for Florida. We're going to take Florida's occupancy allocation, and we're going to go ahead and allocate that 100% this time, and we're going to do that by square footage. So if we look down into our P&L, I've also included the square footage statistic account, and we can see that looks like the British Columbia organization is going to take the lion's share on this one. Everybody's included, nobody's excluded. So let's see how that 216,000 gets splayed out. 216 by Florida for occupancy right there. So I hop over to summary, and update to allocation 3. I see that Florida takes the occupancy source and allocates by square footage, removes the credit entry of 216 from Florida, and then redistributes, and British Columbia being the largest at 18%. So that full 216 gets distributed among all the 10 input level entities. All right, one more time, I'll go ahead and do one from scratch. This one, we're going to plug in California as the source. And this will be expense handoff. We're going to distribute the total operating expenses of California. And this pick list just pulls from the whole P&L. I could pull detail level or summary. And let's allocate 100%. And we're going to do that on a financial account this time. So let's try gross revenue instead of a statistical account. All right, so let's review down below, kind of get a sense of how this is going to work. We have California, and that our total operating expense is the 860 that we see being pulled up. So that 860 is going to get distributed across all 10 organizations based on the gross revenue. Gross revenue of 92 million for the company. Looks like the big winners in this one receiving the most expense is going to be Massachusetts and California. And so if I hop over to my allocation summary, update to allocation 4, and I see that 860 being credited out of California and redistributed mostly to Massachusetts, but to California as well, and all of the other organizations appropriately. All of that info and allocation summary cube gets sent back over to the P&L, as with the previous allocations. 860 gets credited out of California, and then the 201, as well as all the other different allocations, go into that value of what gets posted to the California organization. So I hope this gives some inspiration if you haven't seen allocations before, or if you just thought they were not available in TM1 or not worth pursuing. They can be fairly straightforward, and we are happy to partner with you on how we can implement a good allocation solution for you. All right, we're at 10:43 Pacific. And get into the final slide. That is intercompany eliminations. This one's pretty light because it is a very complex topic that we could spend another 45 minutes diving into, but just gonna outline the definition, how we're doing it in TM1, some pitfalls, some things to watch out for, and that's enough to whet your appetite, and you can reach out with further questions if you'd like to pursue further. So for those not familiar, what is intercompany elimination? That's when you need to post entries to cancel out transactions within the organization. I believe this is a hot button topic for Enron, not eliminating their intercompany transactions and posting bogus revenue numbers. So just as an example here in the bottom of the screen, we have the parent company selling $1,000 purchased by the sub company, $1,200. So the cost of sale being 1,000, the revenue being 1,200, and the sub company then sells to the outside world for 1,500, but it costs them 1,200. So we do report a revenue transaction for the parent company of 1,200, excuse me, and the sub company of 1,500, and that gives us 2,700 revenue without eliminations. On the cost side, we record a $1,000 cost to the parent company, $1,200 cost to the sub, and report a $2,200 cost of sale without eliminations. And of course, we need to eliminate those values to get down to the true number. So if we back out the $1,200 revenue event within the company, we get to 1,500, and the COGS number within the company of $1,200 gets us down to 1,000. So that's the gist of intercompany transactions. We can do these automated. Myths have said you can do these automated. Haven't seen it yet in practice because unfortunately it relies on pristine quality metadata within your source systems. So if your ERP has intercompany account metadata for both accounts and partner entities, and accounting has been properly entering the data to all those fields, meaning that all intercompany transactions are properly being documented in both the selling party as well as the receiving party, then you'd have a chance to automate that within TM1 because you have the source data available, and you can build a TI process off of that, extract, put it into a report, you're off and running. Again, haven't seen it yet because the data quality just isn't there, unfortunately. So oftentimes we end up doing this in an Excel solution, and PAX is a great candidate for that. Here's an example of just doing a Excel template and building it into PAX, and then just putting in your monthly transactions, say management fees, investments, retained earnings of both the source company and source account, as well as the partner company and partner account. And then we can hook up DBSW or DBSend functions to push these values into TM1. Maybe these are just recurring transactions that happen every month, so I can set up a chore or a batch to run these transactions from this template on a monthly basis. So that's a semi-automated solution that has worked well for a lot of customers. And then of course there might be some manual transactions. So maybe we dedicate part of the template and some dbSend functions to enter in new intercompany transactions into the template and post those, and of course preserve this template. So you'll be able to document those intercompany transactions. Important to have this if it's not in your source system. And of course, if you had multiple general ledgers or ERPs and entities in your company that are running different sets of books, they don't really have a place to store this information, because you're not going to store it. You can of course store both transactions on the source and the target, but the fact that both took place within the organization and need to be eliminated, there's not really a placeholder in either of those systems. So there's where TM1 comes in and fills that gap, helps you complete that global consolidation. And so that covers intercompany elims, brings us to the end.